You check your bank balance before you get out of bed. A number on a screen decides how your day will feel. You don't question where that number came from. You don't question who set the interest rate, who priced your rent, who decided your insurance premium last month. You assume a person did, but the real answer is far stranger. Right now in trading floors and lending platforms and insurance offices around the world, machines are already making these decisions. Not someday, now. And the question isn't really whether AI will control the economy. The question is what happens when you finally notice it already does. Think about the last loan application you filled out, or the last time an app told you your credit score. You pictured a banker somewhere frowning at a spreadsheet. But there was no banker, there was a model, trained on millions of data points, scoring your life in milliseconds. Is that worse than a human deciding? Or is it just different? To understand what's coming, you have to understand what money actually is. Money isn't gold. It isn't even paper. Money is trust, encoded into a system simple enough for everyone to agree on it. For most of human history, that system was deliberately slow. A farmer in ancient Mesopotamia recorded debts on clay tablets. A merchant in medieval Florence kept ledgers by candlelight, doing arithmetic by hand. The economist Adam Smith, writing in 1776, described markets as guided by an invisible hand, a metaphor for millions of individual human decisions somehow producing order without anyone in charge. For 200 years, that metaphor held. Humans made the decisions, the market just aggregated them. That stopped being true decades ago, and almost nobody noticed the moment it happened. In the 1980s, a small number of trading firms began feeding stock data into computer programs that could buy and sell faster than any human floor trader. By 2010, algorithmic trading accounted for the majority of stock market volume in the United States. Not most days, most trades. The economist Andrei Schleifer and his colleagues studied this shift extensively, showing that markets had quietly become arenas where machines trade primarily with other machines, optimizing for patterns invisible to the human eye. You still see a stock ticker. You still see red and green arrows. But underneath, you're watching a conversation between algorithms, and humans are mostly spectators. Here's the part that should make you sit up. This wasn't a hostile takeover. Nobody voted on it. There was no headline that said, "Machines now run the markets." It happened the way most enormous changes happen, quietly, gradually. One incremental efficiency gain at a time, until one day the old way simply didn't exist anymore. So if trading already belongs to machines, what's next? Pricing, lending, insurance, hiring. All of it is following the same quiet path. Researcher Frank Pasquale, in his work on what he called the Black Box Society, documented how algorithms now determine who gets a loan, who gets flagged for fraud, and who gets offered a job interview, often without any human reviewing the individual decision. Your application doesn't land on a desk anymore. It lands in a model. The model was trained on the outcomes of millions of past decisions, most of them made by humans. Many of them shaped by the biases of the era those humans lived in. The machine isn't neutral. It's a mirror. But it's a mirror most people mistake for a window. You feel this every day without naming it. The price you see for a flight is not the price the person next to you sees. The interest rate offered to you is not the rate offered to your neighbor. Dynamic pricing models, refined since the 1980s airline industry first deployed them, now exist in nearly every market, adjusting in real time based on your location, your device, your browsing history, even the time of day you're shopping. You think you're negotiating with a company. You're actually negotiating with a prediction about you. Is that manipulation? Or is it just what markets always wanted to do, finally given the tools to do it properly? Now zoom out further. Central banks set interest rates that ripple through every mortgage, every savings account, every business loan on Earth. For decades, That decision sat with a small committee of economists, debating in a room, weighing human judgment against historical data. But central banks have begun quietly testing machine learning models to forecast inflation, predict recessions, and simulate the impact of policy changes before a single human votes. The Bank of England and the Federal Reserve have both published research on using AI systems to process economic signals faster than traditional models ever could. The committee still votes, but increasingly the committee is voting on what the machine already suggested. This is the pattern. At every layer of the economy, from the trading floor to the central bank, humans haven't been replaced. Not yet. They've been moved one step back, from decision maker to approver, from approver, eventually, to spectator. Here's the twist that changes how you should think about all of this. You assume the danger of an AI-run economy is that the AI would be cold, inhuman, indifferent to suffering in a way no human banker would be, but that's backwards. The actual risk researchers worry about isn't coldness, it's the opposite. It's that these systems learn human bias so thoroughly, so quietly, that they launder it. They take the messy, inconsistent, sometimes prejudiced judgment calls of a million human decisions and compress them into something that looks clean, objective, mathematical. A 2016 analysis by journalist Kathy O'Neill, a mathematician who spent years studying these systems, described this exact failure. Algorithms trained on biased outcomes don't remove the bias, they automate it, and then hide it behind the appearance of neutrality. A human loan officer who discriminates can be challenged, questioned, even sued. A model that discriminates just returns a score. Nobody asks the score to explain itself. So the fear isn't a cold machine taking over a warm human system. The fear is a deeply human system, with all its old wounds intact, getting frozen in place by something that finally never gets tired, never gets old, and never changes its mind. And here's where it gets stranger still. An economy doesn't actually need a single AI seizing control to become AI-controlled. It just needs enough small decisions, made by enough separate systems, all optimizing for similar goals, all trained on similar data, all nudging in similar directions. No one designed this. No one is steering it. It emerges the way a flock of birds turns together without a leader, each bird simply reacting to the birds beside it. Economists have a term for this kind of system: emergent coordination without central control. It's the same principle that built ant colonies and termite mounds. Now it's quietly rebuilding financial markets, one automated decision at a time. You might assume this is new, a 21st century problem. But the deeper truth is that humans built increasingly automatic systems to make economic decisions for almost as long as economies have existed. The gold standard was, in its own crude way, an algorithm, a fixed rule that removed human discretion from currency value, designed because humans, left to decide for themselves, kept making decisions that wrecked their own economies. Central banking itself was invented partly because individual human judgment, panicking during a crisis, made things worse, not better. Every step in economic history has involved handing some piece of human judgment over to a more consistent, less emotional system. AI isn't a break from that pattern. It's the most advanced version of something humans have been doing since the first king fixed the price of bread. Which means the real question was never, should a machine run the economy? Humans already decided centuries ago that human judgment alone wasn't trustworthy enough to run an economy unsupervised. The real question is whether the system we're building now can be questioned the way the old ones could. A king who fixed the price of bread could be petitioned. A central bank that raised interest rates could be protested, criticized, voted against in the next election cycle, even if the protest changed nothing. A model that prices your insurance, scores your loan, and ranks your job application doesn't take petitions. It doesn't read protest signs. It updates on the next batch of training data, and the people affected by its decisions usually never learn the decision was made by a model at all. This is the modern mirror. You don't think of yourself as living inside an AI-run economy. You think of yourself as living a normal life, checking prices, applying for things, getting approved or rejected. But the infrastructure underneath that normal life has been quietly automating itself for 40 years, and the conversation about whether that's good or bad started decades after the systems were already running. The takeover already happened. It just didn't look like a takeover. It looked like convenience. It looked like efficiency. It looked like an app that approved your loan in 90 seconds instead of 2 weeks, and nobody complained about the wait time being gone. There's one more layer to this, and it's the layer most people never get to see. Every model that prices your insurance or scores your loan was trained somewhere, on something. The data that taught these systems what a good borrower looks like, what a safe neighborhood looks like, what a qualified candidate looks like, came from decades of human decisions, made in a world with red-line neighborhoods, gendered hiring practices, and uneven access to credit. The model didn't invent those patterns, it inherited them. And because it inherited them from millions of examples instead of one biased manager, the pattern feels less like prejudice and more like fact. That's the trick. Scale makes bias look like truth. Researchers at MIT and Stanford have spent the last decade trying to audit these systems, and what they keep finding is unsettling in its simplicity. You can remove someone's race from a dataset, and the model will often reconstruct it anyway. Indirectly, through zip code, through shopping habits, through the hours someone is active online. The bias doesn't need the original label to survive. It just needs enough correlated breadcrumbs, and modern economies generate millions of those breadcrumbs every second. So even well-intentioned attempts to build a fairer algorithm keep running into the same wall. The economy itself was never fair to begin with, and you cannot train a perfectly neutral system on a history that wasn't neutral. Does that mean the old way, fallible humans making fallible decisions one at a time, was actually better? Not necessarily. A human loan officer in 1965 could deny a qualified applicant for reasons that had nothing to do with risk and everything to do with prejudice. And there was no audit trail, no data set to study, no way to even prove it happened at scale. At least a model leaves a record. At least a biased outcome, once detected, can theoretically be corrected for millions of people at once instead of one appeal at a time. That's the strange trade humanity has actually made. Less individual cruelty, potentially, in exchange for bias that moves at the speed of software updates instead of the speed of one manager's retirement. Consider what this means for something as basic as getting hired. Resume screening software, now used by a majority of large companies according to research from Harvard Business School, filters out candidates before a human ever reads their name. The software was trained on the resumes of people the company hired successfully in the past. If that past workforce skewed toward one gender, one university, one zip code, the model learns that pattern as a signal of success and quietly recreates it, application after application. Long after the humans who built the original workforce have left the company entirely. Nobody told the model to discriminate. Nobody had to. This is why the conversation about AI and the economy keeps missing the point when it focuses only on robots taking jobs. That's the visible fear, the one that makes for dramatic headlines. But the quieter shift, the one already finished in trading, well underway in lending, and accelerating in pricing and hiring, isn't about machines doing jobs humans used to do. It's about machines making judgments humans used to make, at a scale and speed no human committee could ever match, using historical patterns that nobody is fully accountable for anymore. Some economists argue this is simply what progress looks like. Every technological leap, from the printing press to the assembly line, displaced some form of human judgment and replaced it with something faster and more consistent. The economist Joseph Schumpeter called this creative destruction, the idea that old systems must be dismantled for new ones to emerge, and that the dismantling, however uncomfortable, ultimately produces more value than it destroys. Maybe an AI-mediated economy is just the next iteration of that same churn. Faster loans, cheaper insurance for the people the models favor. Markets that price risk more accurately than any human ever could. But more accurately and more fairly are not the same word, and that's the distinction the whole system is quietly skating past. A model can be extremely accurate at predicting that people from a certain background are statistically more likely to default on a loan and still be deeply unfair to the specific individual standing in front of it, who is not a statistic, who is not the average of their zip code, who is simply trying to buy a home. Accuracy at scale can become a kind of cruelty that no individual decision-maker ever intended, and no individual decision-maker can be blamed for, because no individual decision-maker actually made the call. So tonight, when you check your bank balance before getting out of bed, look at that number a little differently. It isn't just an amount. It's the output of a system that decided, somewhere between a server rack and a regulatory filing, exactly how much trust the world is willing to extend to you today. You didn't choose the rules. Almost nobody did. They emerged, one efficient decision at a time, the same way they always have. The real answer was never that AI might someday control the global economy. The real answer is that it already does, quietly, and the only thing left to decide is whether you ever bother to ask it why. Don't forget to subscribe for more What If videos to make you think.